Ahmed Tinubu has requested the National Assembly approval for an external borrowing plan totaling $21.5 billion and a domestic bond issuance of $757.9 billion. The borrowing, targeting infrastructure, agriculture, health, education, and employment, aims to address Nigeria's growing infrastructure deficit following fuel subsidy removal. Tinubu also seeks to settle outstanding pensions liabilities under the Contributory Pension Scheme. He emphasized that the bond plan already approved by the Federal Executive Council will boost retirees' welfare, restore confidence in the pension system, and inject liquidity into the economy. The Senate has referred the request for review. Samuel Oyekanmi, Research and Insights lead at Norrenberger Financial Group, joins me now for this conversation. It's a pleasure to have you in, Samuel.
Thanks for having me, Joanna. Good morning.
Good morning to you. Now, we're coming from celebrating a couple of weeks ago, Nigeria paying off the $3.4 billion IMF loan, a month before time. And now we're going on a loan binging spree. Just to share the details, we have approximately $23.5 billion and in euros, 2.26 billion euros. I'm sure you can share with us more of the details, but how are you reacting to this strategy around debt management?
I think it's quite interesting because, and I think a number of people in the market, analysts and economists, have also reacted to how this new borrowing plan is going to impact our debt levels, currently at over 144 trillion naira. GDP debt to GDP ratio at around 54%. So it's quite interesting seeing that we are going on this very high borrowing spree. But again, it comes back to the fact that we've also been dealing with significant budget deficit. Revenue numbers are also not panning out. We had a benchmark of something around $70 per barrel. Right now, we are trading around $62 to $63 per barrel. So it means that there's a shortfall from that end. And of course, you ask yourself, where else will the government be able to fund some of these budget requirements? I think the obvious choice at that point will become borrowing. But the dicey part is that we are borrowing significantly from the domestic market. We're also having this huge form of borrowing plans to the tune of about $21.5 billion from the external side of things. That's a quantum. Unfortunately, again, we have a huge part of that is also going to be spent on debt servicing. So at the end of the day, it might not really be giving us the positive net that we are looking for. It might just be a trade-off. I think we've had that conversation a couple of years ago when we said that Nigeria is in limbo, keep borrowing to service previous debts, and it might just be a cycle again. But then we hope that this new administration has some things in place to ensure that there's a bit more transparency, accountability, and then these plans, as it were, also come to fruition.
I hope the plans come into fruition because that's a lot of money as we invested in infrastructure. But then there are those who are also saying, are lauding the methodology, right? Instead of printing more cash, ways and means, they are, taking some other means, bonds and all of that. What are your sentiments around it?
Yeah, it's been a conversation before now about the ways and means that we had a couple of years back during the COVID-19 and the past CBN administration had spurred a significant increase in terms of our money supply. Remember then our money supply was around the region of 30-ish trillion naira. Right now we're trading 120 trillion naira. Of course, there is a dollar factor in there, but it started from the significant pumping of cash into the economy. Currency in circulation is about 5 trillion naira. So when you look at that in perspective, you realize that printing money has a huge downside to us, especially from the inflationary side of things. So in as much as you want to be able to raise funding, I think the government is quite doing that right now. We see a lot of T-bills auction going on. Yes, high yielding environment. You also saw doing about 2 days ago bond issuance also. The government is also trying to raise capital from that. They also sukuk bonds and whatnot. So the government is trying to pretty much be innovative around raising capital in order to meet its fiscal expenditure requirements. And I think that's quite interesting because going back to ways and means is really not a good way to go. We are yet to recover from the shocks that were caused as a result of that huge pump of cash into the economy from 2020. And right now, even despite high interest rate environments, the money supply M3 is still at record highs. And we really can't say until when that is going to change, really.
All right. And now coming to, yes, there is a part of the money that's going to go for infrastructure, but there's also the federal government's domestic bond that they hope to issue to settle pension liabilities. So they're issuing bonds for settlement of liabilities. What are your thoughts on that as an investment strategy, right? With bonds not to invest, but to settle liabilities?
Well, so I think you have to look at it from two sides. The first side being the fact that we have several debt instruments that the government raised, many of which are channeled towards infrastructure. Some others are also used to pay maturities of existing debts. So this is just going to be a form of securitization of government debts to retirees. And I think it is due for the government to start paying back to retirees, because what it does again is that it also boosts the confidence in the pension scheme. You see many older retirees who have been born or who have not received their portion of their retirement benefits in time past. The level of confidence in the pension industry needs to grow. And this is part of some of the reforms that would help to drive that level of confidence again in the pension industry. In terms of government using debt to pay back debts, the truth is that has been happening before now, and I don't think it's a new thing. The only thing is that we need to start weighing the pros and the cons. The pros here in the sense that we'll be able to drive some level of liquidity into the hands of Nigerians who have worked and, of course, need to earn their retirement benefits. That is going to drive confidence in the pension industry. There's going to be liquidity, more spending from that end, and also driving economic growth. Again, more risk assets well for the likes of asset management companies, the likes of pension administrators who also look for assets to be able to invest in. I think that also helps to achieve that, because of course you already spoke to that, and I still say that that's not new, really.
Yeah, well, it's not new, but at least the pensioners are somewhat benefiting from this. And coming to the timing of this borrowing amid subsidy removal and revenue shortfall, what's your assessment of the strategy? We know that the argument for subsidy removal was that we're going to save money, and now it's a reason to borrow more. What are your thoughts around this?
Yeah, so seeing that as part of the communication was also it was kind of confusing to many. And I was also trying to, you also need to play the two-side game, so trying to play the devil's advocate, trying to understand why subsidy removal is going to be a reason to assess more borrowing. I was trying to say, okay, the fact that the economy has been rather hard, the non-oil part of the government revenue could have been impacted. And I went through to look at tax revenue for 2024. I saw that at over 21 trillion naira, way more than even the budget for the year, and it's significant, more than 100% increase compared to the previous years. So it means that tax revenue has not really taken it, despite the fact that the economy has relatively remained hard. Of course, the oil part of things, we are down below what we expected in terms of benchmark. In order to be able to meet that budget of region of 50 trillion naira, there would need to be borrowing. How we are going to get that, of course, it has always going to be a mix of local debts and then external debts. The problem is just that the removal of subsidy should not be a criteria for say more loans. But then again, go back into the past. Petrol subsidy takes about 4 trillion annually, 4 to 6 trillion annually. And then when you look at our deficit, there's still a huge chunk, maybe about 14 trillion. So of course, there would definitely be the need for borrowing, but we need to be more accountable, and there needs to be a lot more transparency in terms of how these monies are being used. Because again, you go back and forth here, issues around the CBN, the NMPC, trying to deliberate on some of the funds. that were supposed to be back to the Federation's coffers as a result of subsidy removal. We tend to see a lot of arguments around that. And as a result of that, it's really not so much confidence in terms of the level of transparency and responsibility on the part of the government to ensure that they do what they said they are going to do. And again, it makes Nigerians raise a lot more questions with this borrowing. Are we really going to see many of these promises in terms of agricultural health, education, our infrastructure deficit is estimated to go over $800 billion by 2040. And they're huge. If you look at the ranking from the African Development Bank, you see that Nigeria really lacks significance, especially when it comes to things like transportation, electricity. We really need to bridge some of those gaps. Again, you look at the government concession plans, out of the 35 concession plans that have been approved since 2023, only about 65% of them have not even closed on financing. So we're having issues around some of these infrastructure that we really want to put in place, but then again, it's really not materializing as a result of delays or as a result of the funding is not coming in. When you put all these into perspective, it makes Nigerians question the level of transparency that comes with such huge borrowing plans going forward.
So transparency and accountability, we need to see more of that, especially if you're looking to borrow such huge sums. Coming down to the macroeconomic implications of this borrowing, we're borrowing in multiple currencies, USD, Euro, Japanese yen. How is it going to impact, some of our macroeconomic indicators?
I'll start from the pros, right? I think diversifying your debt in terms of currency is not a bad thing. It's actually good. It helps you also to de-risk as much as possible. But then again, on the other end, it could also form some level of pressure because, of course, major source of FX is oil, and any shock around the oil market tends to affect exchange rate. So exchange rate is always the indicator that suffers the most because from the fallout of what happens either as a result of international trade or from our balance of payment, by the time we start paying some of this loans, yes, of course, they're going to be, according to the government, it's going to be concessions that's going to have very long periods of repayment. But at some point, we have to still repay, right? And even beyond that, we have ones that we are still currently repaying either to the World Bank or in terms of the Euro bonds maturities. And at those points, you find that you start having pressures on your exchange rate. So, for example, so far in 2025, between January and April, Nigeria has spent over $2 billion repaying debt. And that is like over 50% compared to last year. About 45% of the total that was paid last year. So it gives you an indication that this year we are heading towards the right in paying a record high in terms of external debt servicing fee. And that, again, comes back to your question of the impact in terms of negative impacts on macro numbers. And the major indicator that suffers from that is exchange rate. That is considering that we do not have the FX backing to be able to pay back this repayment. It causes a number of pressure. But hopefully, with a number of reforms that we're seeing in terms of tax reforms that is expected to also improve tax collection, and then a number of reforms around the exchange rate market also that has helped so far stabilize exchange rate. And hopefully that we don't see so much shocks again in the international market, we might be able to mitigate that impact on exchange rate going forward.
I think reforms have pretty much defined this administration so far. But for Nigerians seeking to justify this $21.5 billion to be pumped into infrastructure, do you see this borrowing plan realistically delivering on its promise of job creation, poverty reduction, food security, and it's 2025-2026 that this money is to be expended? So do you see it realistically achieving those goals?
Well, as an analyst, it can be quite dicey when you look at it. In terms of bridging the gap, it's just going to be like a drop in the ocean, really, because research has shown that we need at least about $100 billion annually to be able to meet our infrastructure gap. So, of course, 21.5 billion is just going to be, that's in 2 years, it's just going to be part of it anyways. But then again, it goes back to the level, the will of the government to be able to follow through with their plan. There have also been conversations around issues of corruption. Oftentimes you find around things that has to do with the government. If you're able to curb those corruptions, we see transparency, accountability, prudency also in spending. Maybe if we could be able to see the impact of the 21 billion, at least to be able to meet some of these things. So you look at numbers, for example, the rail transportation sector is one of the cheapest form of transportation in Nigeria. But when you look at it compared to the larger transportation sector in Nigeria, it only accounts for less than 0.01% of that industry. And that tells you that we have a lot more to do to be able to connect in most regions in Nigeria by improving things like rail transportation, for example, things like warehousing in terms of food storage. And that's why Nigerians find oftentimes we can't export as much.
So there are there are, from what you're saying, there are low-hanging fruits, and it may be a little drop, but little drops do make an ocean. Thank you very much, Samuel Oyekanmi, Research and Insights Lead, Norrenberger Financial Group.